What a wild day for silver. If you're looking at silver right now, you might be wondering if it's too late, too risky, or if it's about to explode. You're asking the right questions, but most people are using the wrong strategy. Please subscribe before we get started. Thanks. The reality is, silver is not just cheap gold. It trades differently. It moves differently. And if you treat it like a normal asset, you'll get chopped up. Today, I'm going to show you a smarter way to approach the current silver market step by step. Risk-aware, tactical, and practical. No hype, just strategy. We're going to cover why silver behaves differently than gold, what actually moves silver prices, the biggest mistake retail buyers make, and a 3-lane strategy, depending on your goal. We'll also talk about how to avoid buying at the wrong time and how smart money scales into metals. Quick note, this is not financial advice, just an educational framework. Always do your own research. Let's get into it. So, why is silver different? It's as unique because it sits in two worlds at once. It's a monetary metal and an industrial metal. Gold is mostly monetary. Silver is both. That means silver reacts to inflation, interest rates, dollar strength, industrial demand, manufacturing cycles, solar production, electronics demand, and speculative flows. That's why silver often moves later than gold, moves faster when it breaks, and pulls back harder after spikes. It's more volatile, but that volatility is where strategy matters. If you only remember one sentence from this video, remember this: silver rewards scaling, not chasing. What's driving silver right now? It's being influenced by several forces at the same time. First, industrial demand, especially from solar and the green energy transition. Second, inflation hedging behavior. Then there are central bank and currency concerns, rate expectations, and gold's leadership moves. Finally, retail investor flows play a big part. Silver rarely leads the party. It usually follows gold and then accelerates. So instead of asking, is silver cheap? The better question is, where are we in the cycle? Because silver performs best after gold trends. During inflation scares, during dollar weakness, and during risk rotation. Not randomly. Now, let's talk about the biggest silver buying mistake. Most people buy silver emotionally. They buy at price spikes, after big headlines, after huge green candles, and after social media hype. That is completely backward. Smart accumulation happens during pullbacks, during consolidation, during periods of boredom, and during doubt not excitement. If you feel a sense of urgency, you're late. If you feel patient, you're early. So before buying silver, ask yourself, is the price extended way above its trend? Did it just spike? Is social media suddenly excited? Are headlines screaming? If you answered yes, wait. Here's a smart 3-lane silver strategy. This is a framework, not a prediction. Pick your lane. Lane 1 is for long-term hedge buyers. If your goal is wealth protection, your strategy is dollar cost averaging. Make fixed monthly buys, ignore short-term price swings, and focus on the total ounces you own. Use pullbacks to add more. Your tools are physical silver, allocated storage, and low-premium sources. Your mindset is, you are not trading, you are accumulating. Lane 2 is for tactical swing investors. If your goal is to profit from price moves, your strategy is to buy during consolidation ranges and add on technical support zones. Scale your entries, never go all in at once. Predefine your exit targets and use partial profiting. Your tools are silver ETFs, liquid vehicles, and chart levels. The rule here is, never chase breakouts without a plan. Lane 3 is for volatility traders. This is higher risk and requires higher skill. The strategy is to trade volatility bursts, use smaller position sizes, and always respect stop losses. You trade around catalysts and never average down on losers. Your tools are options and leveraged vehicles. If you're new, this lane is not for you yet. Instead of guessing tops and bottoms, use a staging framework for your entries. For example, you could put 40% of your position in at a support level. Add another 30% if it dips further, and the final 30% if the trend confirms a move higher. This removes emotional pressure. You stop trying to be perfect and start being strategic. Silver punishes perfection attempts, but rewards disciplined staging. A common myth is that silver is about to skyrocket tomorrow. The reality is, silver moves in waves and squeezes, not straight lines. Plan for waves, not rockets. Every silver buyer needs risk rules. Never go all in at once. Never buy the spikes. Never use money you'll need soon, and never ignore volatility. Always size your positions modestly, stage your entries, know your reason for buying, and know your exit condition. Strategy beats prediction. If you want, I can make a follow-up video breaking down physical silver versus ETFs, the silver-to-gold ratio, how to spot accumulation zones, and silver cycle signals. Subscribe, because this is part of a metals strategy series. And the next video goes deeper into timing and positioning frameworks. And again, this is for educational purposes only, not financial advice. Do your own research and risk planning. See you in the next one. Stay safe, and please like and subscribe.